Okay, let's look at this intercompany elimination problem. We've got the Hollow Corporation, and they acquire 70% of Surge Corporation's voting stock on May 18th. Now, I'm just reading right here, okay? And the companies reported the following data with respect to intercompany sales. So for 2005, Sung purchased at a cost of 120, or purchased by and sold to is a little bit misleading here. In 2004, Sung sold to Hollow Corporation 180,000 of merchandise. At the end of the year, 45,000 was unsold. Okay? Now, Hollow reported operating income, excluding any income from its investment in Surge, of 160,000 and 220,000 in 2004-2005. Surge reported income of 90,000 and 85,000 in 2004 and 2005. So the first thing we want to do is compute the consolidated net income for 2004. Now before we do that, I want to just illustrate on this screen here what we know. Okay, there was intercompany sales of 2004 of 180,000. The cost of goods sold was the 120,000. That comes from right here, right? So we had a sale of 180. The actual cost of the goods sold was 120. Therefore, the gross profit is 60,000. That's a gross profit percent of 33%. Now, if 45,000 is unsold at the end of year, then if we take 33% of that, we know that there's 15,000 of profit or gross profit still sitting in inventory. Okay? Now, let me slide up and show you how we calculate the answer. Hollow Corporation recorded income of 160,000. That's given right here. Surge reported 90,000. That's given right there. But we have to subtract out the unrealized profit that's still sitting in inventory. Otherwise, we would be overstating net income of the two organizations. Okay? So consolidated net income represents the sales, the combined sales that they had, that they reported, less the profit in inventory of 15,000. And that's how we calculate consolidated net income of 235,000. Okay, now we're going to work on Part B, and I've slid back up to the top again. We're using the same data, and now we have to compute the inventory balance reported in the consolidated balance sheet at December 31st for the transactions shown. Alright, so let me slide back up. We still have the same information, only now remember in 2005 we had a purchase price of $90,000 with an intercompany sale of $135,000, and at the unsold at the end of the year is $30,000. Okay, and then they also tell us, well, when was it actually sold to an outside party? For 2004, it was in 2005 when that unsold amount was finally sold, and in 2005 it was 2006. Now also in 2005, we had an intercompany sale going the other direction of $280,000, and $110,000 was unsold at the end of 2005. And again, here too, both of these transactions in 2005 moved on in 2006. So let's see what we have to do to compute the inventory balance. Well, let me move out of this out of the way. Now, we've got to look at the transactions both ways. One company sold to the other 135 at a cost of 90,000 with a gross profit. That's our 33% margin, right? Very similar to what we looked at earlier. So we know of the 30,000 in ending inventory at the end of 2005, a third of that represents profit in inventory. We call it gross profit. I'm used to calling it profit in inventory. Now the sale going the other direction was $280,000 with a cost of $140, so we've got a 50% markup, and $110,000 was remaining in inventory. So if we take 50% of that as its cost, then I know that $55,000 is the gross profit remaining in inventory at the end of 2005. So now to calculate the inventory balance in the consolidated balance sheet, we have to use this kind of logic. Let me slide a little bit more. Hopefully we can get this all on the screen here. The inventory reported by Hollow was $30,000. Right? That's our $30,000 here. The unrealized profit that Surge had on its books was the $135 less the $90 times $30,000 divided by 105. So in other words, we take the margin times the $30,000 to compute the $10,000. Right? That's the same 10 you see here. And then when we go the other direction, we had a sale of $280 less $140. Now, in this case, we had $110,000 out of the $280. Oh, by the way, let me restate that. That 30 divided by 135,000 means you take the percentage of the total sale, 30 divided by 135, and multiply it times the gross profit of their total sales. So in other words, we're doing an averaging technique so that we correctly state the inventories at the correct balance. So when we do it for the transaction that went the other way, we have to compare 280 less 140 to give us 140,000 a margin, and then we allocate that portion that's still on the books. 110 divided by that 280 is a little bit less than 50%. We multiply that times that 140 of margin, we have 55,000. That's the inventory reported that still has to remain on the books. Actually, that's the unrealized profit that we have to subtract from what they've already reported. Right? Hollow reported 30,000 total inventory, but 10,000 of it, some allocation of the total intercompany sale, is still on the books. And we do the same thing for Surge. So when we add up the two net balances, we're able to come up with the consolidated inventory balance that would be reported for 2005.